You know, this is a very strange auction. First of all, I'm going to give it an A-, which is a pretty good grade, and you'll hear why in a moment. 54 billion two-year notes. The auction yield, 0.99%. It was a bit lower than the market was trading in one issue market. Lower yield, higher price. That helps the grade tremendously. Let's go through the highlights, shall we? 2.81 bid to cover. That's a biggie. That's the best since April of 2020. But here's the metric that really caught my eye. Indirect bidders, okay? Foreign entities, the ones we really should be paying very close attention to, 66%. That's the best since the summer of '09. The one fly in the ointment were direct bidders at 9.4%. That's the weakest since March of 2020, but it's well below 10 auction average. If you look at 24.6% for dealers, that's pretty solid. So one bad metric, several extraordinarily good metrics. A-. And what is it telling us? It's telling us Wednesday last week, the 20-year, aggressive bidders. The 2-year, you talk about the biggest dagger falling from the sky, short maturities, most likely tied to the Fed. And everybody's talking about the Fed. Oh, my God, they haven't really done anything yet. So investors really stepping up, thinking the current activity may somehow affect the way the markets are trading, maybe this week's Fed meeting. But in the end, the two topics that I'm hearing the most of today is geopolitics and the balance sheet. If you really want to do something, quit buying more treasuries now. Kelly, back to you.
We will have more on geopolitics in just a minute, Rick. In fact, let me ask you, though, because what David Bahnsen just said was very interesting. The main market narrative right now is the Fed has sparked this sell-off because of its tightening, and so everyone's speculating if they're going to have to back off because the market's down so much. Bahnsen said that's not what's happening at all. These stocks just collapsed under their own weight. They ran up too much, in which case it would have no implications for the Fed backing off. And if anything, maybe they maintain or stay aggressive and hawkish.
That all sounds very easy to say, and I don't necessarily disagree with the logic. But the Fed and the free put with equities, that goes back to Alan Greenspan. I'm not so sure how much nerve they have, but I completely agree that somewhere along the line since 2007 and 2008 and all the sins committed against the free market where people actually have price discovery, there has to be a cost, there has to be pain, and we are experiencing that right now.